Silver has been the best performing commodity of 2016, and in appreciation of our listeners, Palisade Radio and Palisade Research are giving away a free American Eagle 1-ounce silver round each and every week for the rest of the year. Just visit palisaderadio.com and enter your email for a chance to win. Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Back on the program with us today is returning guest Bill Holter. We've had him on a few times in the past. He's got a very, very large following. Bill, welcome back to the program.
Thanks for having me, Colin.
I think it's been probably 6 or 7 months since we spoke last. One thing that's happened, of course, is the reemergence of a gold bull market. Something that you've been talking about since you began writing is the place for gold in society today. And the gold stocks have been on an absolute tear, which is another thing that you were talking about. I know you've made some investments into certain gold companies. I'm sure they're doing very well. Bill, why don't we just start off talking about where you see gold after the last 6 months?
Well, we're in a pullback phase. We've seen reactions in both gold and silver. We've seen a bigger reaction, and they were due for a reaction in the mining shares. We've had a 15-20% pullback, but you're going to see these in a bull market. The mining shares are still, in my opinion, quite undervalued. Silver is still quite undervalued compared to gold.
These are all very true points. We've been putting out some charts on Palisade Research kind of highlighting where we are in the cycle if compared to cycles of the past. And one could make an argument that this bull market, if it is anything like the ones of the past, is going to be 4 to 6 years, maybe much longer than that in these mining shares. And you take the last 6 months, what we've had, and put it on a chart of 6 potential years, and there's just not been much movement at all. And then on top of that, the mining shares were just so undervalued against the price of gold. It was almost as if people were pricing in gold well below $1,000. Where do you think that gold goes from here for the rest of the year?
I think the shares we're pricing in, you could call it $300 or $400 gold. You're trying to compare this bull market to past bull markets, and I don't think that's a valid comparison. The reason being, previous bull markets, we were not looking at the potential end to the financial system as we know it. And that's where we are right now. We're 7 or 8 years into a monetary experiment, which has never been done before. It's never been done before because when central banks monetize, they destroy the currency. And we've got central banks all over the world monetizing. So to compare this bull market with past bull markets, I don't think is really valid. This is going to make make history. This is going to be different because you're looking at the end of a system and the dawn of a new system.
I think what's been very confusing to investors is the fact that the equities in the U.S. have continued to rise. And at some point, even though monetary easing and negative rates is maybe what's causing the Dow and the S&P to continue to rise, the house of cards is going to have to fall. Myself, I expected that to kind of already begin happening. I know that you've spoken about the potential for a market crash to occur. Do you feel like we're getting imminently close to things finally collapsing on that side?
Well, I think we've been there a couple times this year. I think we were there in February this year, and then again after Brexit. And I think what you're seeing, and the numbers bear this out, is now you have central banks that are actually purchasing stocks. The Bank of Japan owns a huge amount of stock. They've basically nationalized their own stock market. The Swiss National Bank has bought, $60-70 billion worth of stock. Even the Norwegian Central Bank. For central banks to step up and buy stocks, you have to ask yourself, how is it possible that stocks back the money itself? And that's where we stand now. And that's what has been one of the things, the monetization of the stock market has been one of the things that has prevented the stock market from collapsing. Now, I do expect a crash in the stock market. You might see 10,000, you might see 5 or 6,000 in the Dow. But as you've seen in all previous hyperinflations, stocks will go higher in a hyperinflation. Money will come out of fixed income, money will come out of banks, money will come, I shouldn't say money, I should say capital will come out of currency. It'll be coming out of currency as a way to protect itself. And the way to protect itself is to buy stuff. So I think you will see, I think you could see a much higher stock market a year, 2 years, 3 years from now after an initial dump in prices. I think the companies that will do the best are the ones that are commodity oriented or actually make things, as opposed to financial companies like banks, insurance companies, or even high tech. The esoteric type stocks I don't think will do as well as stocks that make meat and potatoes, so to speak.
Well, Bill, so many factors are skewing the market up that you just pointed out. You've got central banks buying stocks. You've got people chasing yield because they can't find it in traditional places like bonds. And then you just mentioned the Norwegian central bank, which I believe I just read a report that they're now buying gold stocks, which I found quite interesting. Did you read into that?
Yeah, they they have been buying mining stocks, I guess, for the first half of the year, and that makes sense. They're an oil producer. They understand better than maybe some other central banks. They understand that they're investing in something real, because Norway is an oil producer.
Yeah, it's one of the few governments that's actually done a decent job of building up capital and money for its citizens. Bill, you put out a chart a few weeks ago. I think you sent around a chart, I should say, that you had found, and it showed the gold to money supply ratio. And basically what it points out is that the amount of gold out there for the amount of dollars is simply not enough right now, and kind of at an all-time low. We took that chart and added the M2 velocity to it. I'm not sure if you saw that when we published it. But
No, I didn't see it.
Well, what it showed is not only are we at the low point for how much gold there is per dollar out there, but the velocity of money is on the M2 side is the lowest that it's ever been. So just
Right.
Yeah,
It's crashed. The velocity has crashed. The turnover has crashed, and that's the fact that velocity is the lowest it's ever been. Is why there's no money in the streets, so to speak. That's why it feels like we've been in, what, a 7-8 year recession or longer.
Well, Bill, to get inflation or hyperinflation, there needs to be not only a lot of money out there, but velocity. What do you see kicking the velocity back in the other direction?
A flight from currency. I think that would turn velocity if at some point in time these negative interest rates, and you're starting to see this in Germany, by the way, they're scared and they're actually hoarding cash. So, and one of the reasons they're hoarding cash is they're pulling it from banks because they don't want to pay to keep their money in the bank. But once some type of event comes out, and it doesn't have to be a big event, it could be a big event, who knows? But once investors or even the average public is all of a sudden afraid of holding currency, then you're going to start to see it move. And it'll move into stuff. And there's your hyperinflation. In other words, the money supply is already there. They've already printed the money. Now it's just a matter of when does the panic out of money, people wanting to get their capital out of currency and into something real. Once that happens, you'll see velocity turn, and you'll see hyperinflation kick in literally overnight, like a light switch.
It's hard to grasp just where all this money is gone. You've had the money supply increase by 3 or 4 fold in the last 10 years, and people, the average person does not have 3 or 4 times more money in their pockets. I know there's been some inflation, but certainly, you or me don't have 3 or 4 times as much money sitting in our bank account as an average American. Where is all of this money sitting?
It's gone into debt. It's gone to fund debt. Just look at the amount of debt. The world has at least double the amount of debt today as it did back in 2008 across the board, and including sovereign treasuries. Look at the U.S. debt. The U.S. debt has gone from 9 or 10 trillion to 18, 19 trillion. Now look at the ECB. Look at Japan. Look at what the central banks have done, and what the treasuries of these countries or unions. Look at how much they've issued. So the creation of debt has gobbled up the money supply. That's where it went.
I'd be interested to get your take on a question I've asked a few other guests, which is, if we have the Dow drop to 10 or 5,000, mining shares, of course, are stocks. And when there's a event where you have deflation in the stock market, it typically hits all sectors. However, if gold is going up at the same time as this is happening, one could also make the argument that mining shares should stay tied to gold and actually move up substantially at the same time. Have you given any thought, I guess, just for protecting your own capital on your ownership in these mining shares, what might happen to them?
I could envision when the stock market finally does turn and control is being lost, I could see a time period of a week, 2 weeks, maybe a month, where the price of gold is actually going down. You have sellers to meet margin calls. You somewhat saw that in 2008. But gold will turn. You will see capital move into gold, understanding that central banks have lost control. Now, as far as the mining shares are concerned, they probably would track gold. And when gold turns, I think you'll see a mass influx of capital into the mining shares. And I think they'll take out the 2011 highs and then some, possibly by multiples. When this is all said and done, if you go back 100 years or a little more than 100 years, it used to be that mining companies were pretty much like utilities. In other words, they had static costs and pretty much a flat or static price of gold that they could sell their gold at. And I think that's what you're going to see. I think gold is going to be marked up to levels that people can't even fathom at this point, and mining companies will become like utilities. They'll be digging money out of the ground. Because I do think that whatever new currency comes forth, it's going to have some type of gold backing on a ratio basis or something of that nature.
Bill, in an article that you penned and sent out yesterday, you were talking about gold as pure liquidity. 2008, which you referenced, was a solvency problem treated with liquidity, and you now see gold coming in as pure liquidity. Explain that to our listeners.
Yeah, I penned that article because there's a lot of people who think that they're safe, that they're hedged. And the point to that was, you could have money in the bank, you could have money in sovereign treasuries, you could be long and short, you could be long a stock and own puts on it or whatever, but you have counterparty risk. And that's the big problem, is this is going to be a systemic event. And if your counterparty can't perform, then you become illiquid. So what you think is liquid today may not be liquid tomorrow. Now, in the case of gold, if you own physical gold, I'm not talking about an ETF, I'm not talking about miners, I'm not talking about a pooled account, I'm talking about physical gold that's in a non-bank vault. That is liquidity 24/7. You can always pull it out. It's saleable, liquid anywhere around the world. That's pure liquidity. And what I wrote this because 2008 was a solvency crisis that was treated with liquidity. And we've seen trillions in liquidity pumped into the system from 2008 until now. And at this point, liquidity is again tightening. It's again beginning to dry up. That's why you're hearing about helicopter money and negative rates, et cetera, et cetera. Liquidity is drying up. And in the coming event, which is a solvency crisis, but it's going to be viewed as a liquidity crisis, your pure liquidity will be physical gold. And you don't even have to believe me. I wrote this in the article. Just go back and read what Alan Greenspan said about gold in 1966. It is pure liquidity.
All right, Bill, one last point I want to touch on. I think that it has quite a bit to do with everything we're talking about here, and you brought it up to me before the interview. It's Apple just getting ruled by the EU to have to pay $14 or $15 billion in taxes based on what the EU is claiming was fraudulent tax practices through their company in Ireland.
Well, the first thing that comes to my mind is this has been going on for years and years and years. This has been going on since before the year 2000, I believe. So this is not something new. Why all of a sudden is Apple being handed a tax bill of $14.5 billion or euros or whatever it is? My next question would be, who's next? And the reason I say who's next is we know there's several $trillion that have not made it to U.S. shores and been taxed. We know this because, just for example, over the last several years, there have been people talking about allowing this capital in at a 10% or 15% tax rate as opposed to the corporate tax rate, which would be much higher. So it was like an amnesty type of thing that they've talked about. So my questions are, why now? And who's next? And I think the answer to why now is it's a form of economic war. And that's a war between the EU and the US Treasury. You only have to go back, 6 months or a year ago, the US fined BNP Paribas $9 billion or 9 billion euros. That was an act of war. And there's time, space between it, so I can't say this is retribution, but this is definitely, if you were Jack Lew or somebody in the Treasury or somebody in the administration, you'd have to view this as an act of war, because what they're doing is they're placing a tax on this capital, and we were looking at it as when it does eventually come into the U.S., we're going to tax it, we're going to get the revenue. So it's going to be interesting to see what happens over the next few months as to how this is going to play out, because it's not a good thing. This is going to get bigger and bigger.
A reminder to all of our listeners, if you go to PalisadeRadio.com, we're giving away a free silver ounce every single week. Just put in your email and your name and you'll be entered to win. We're also giving away a free silver report on different ways to buy and get invested in silver for everybody who signs up there. Bill, I know that since we talked last, you've officially launched your site, which is the Holter Sinclair site, which I now believe you have a paid subscription to. How do people find out and get signed up for that?
Right, it's still the same site. It's jsmindset.com. We have a public side and we have a subscription side. On the subscription side, I generally write 2 to 3 articles per week, and I do write 1 or 2 public articles that goes out to our site and all the other sites that have carried my work. Also on the subscription site, Jim and I do an interview of each other usually over the weekend, and we put it up Sunday, Monday, something like that. So there's generally about 4, sometimes 5 interviews between me and Jim. That's part of the subscription. It's very reasonable. I believe it's $119 a year right now, and that'll be going up in 2 or 3 weeks to $129. That was just the inaugural price. So I encourage you, if you want to read my work, if you want to see an interview, I say this all the time, just listening to Jim 4 times a month is worth the price of admission. He's brilliant.
Yeah, I would agree with that. Bill, thank you so much for coming back on the program again. It's always a pleasure.
My pleasure, Colin.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, troll, did you hear what's going on in Yemen, or are you too stupid?